Welcome to Turning Hard Times into Good Times. I'm your host, Jay Taylor. And I'd like to remind you each and every week I'm also the author of a newsletter, Jay Taylor's Gold, Energy, and Tech Stocks. I do want to thank each of you for listening to this show, making it one of the more popular shows in the Voice America Business Channel. Also want to thank our sponsors for making this show economically viable. Our sponsors for today's show are RN Resources, Brazil Resources, Columbus Gold, and Trimetals Mining. Well, after the greatest bear market for gold and gold shares that I can remember in my lifetime, at least, from 2011 through the first part of this year, it was really terrible. But from so far this year, things are really looking up. In fact, my portfolio is up some 60%, and the exploration stocks are up over 200% so far this year. And it is certainly one of the most exciting times that I can remember. And if we just simply tread water from here on to the rest of the year, it will have been a very successful year. But will we just tread water from here on? And we're going to be talking to Michael Oliver in just a minute or two to get his take on that. What is his work telling him? His very objective work, I would suggest, and so we always value Michael's remarks. He's going to be with me in just a minute or two. Those of you who subscribe to my newsletter know that I work extremely hard to try to understand the fundamentals of these junior exploration companies, to try to understand the geology, the prospects, the economic factors that could go into making a project one day profitable or not. Well, one of the companies that I hold in most high esteem, RN Resources, we're going to be talking to the executive chairman, Ivan Bebek, in just a couple of minutes after our first break. RN Resources is run by Ivan and also Sean Wallace, who together these guys have been extremely successful in the past. They're putting together something I think is going to be their biggest success yet. They have a project in Nunavut and a couple now in Peru and one in British Columbia. All of them look like they could be world-class projects. Tremendous potential for all of them, and so I am extremely excited. It is now my second largest holding among the junior gold shares that I personally own, and of course it is one of my favorites in my newsletter. My main guest today is the distinguished author and past Wall Street analyst, continuing Wall Street analyst actually, John Rubino, and the main question for John will be, what impact, if any, will the Brexit have on the price of gold? And John will be with me following my discussion with Ivan Bebek at about a little past the half hour today. Of course, informed as John is, and as much as I tend to agree with him based on a shared free market philosophy, one thing all of us free market advocates know to be true is that the collective wisdom of markets is far superior to anything any one of us may think. So communists and fascists, like those who seem to run our country these days, don't seem to understand that concept, but certainly Michael Oliver does. He knows that the collective wisdom of markets is superior to anything any of us might know, and he really has some very good techniques for reading the markets and understanding those markets. So I'm really pleased that he can be with us once again. Thanks for joining me again today, Michael.
Great to be here.
You know, my partner Chen Lin voiced the following view about gold, and I want to his view of the markets, the gold markets this year, and he said, and I want to get your take on it. Chen said, and I quote, "As far as gold and gold miners, my view is that we will need to consolidate a little here before the next move. We need to retest somewhere in the 1275 to 1300 area. The gold future positions is close to all-time high and similar to early 2008. I don't see it as a bullish sign," end of quotes. So what are your thoughts? Are we going to tread water the rest of the year? Could we see some more to the upside before the end of the year? Or are we vulnerable to the downside?
I think the vulnerability to the downside is past. I think we've just gone through our major congestion for gold. Remember, we surged into February, went up from the low 1100s to 1260 in a thunderbolt. And then from mid-February, March, April, May, it's 3.5 months, you stayed in a box, basically defined by just below 1200 and just above 1300. Swinging back and forth, and every time there was a downswing, the doubters would come out, and Goldman Sachs would say short it, and so forth and so on. What they were overlooking, or were not conscious of, because they look at price charts primarily, I guess, is that when gold moved up to the low 1100s in early February, our work had a massive annual and quarterly momentum base that was 3 years wide. In other words, if you were building a building, the bigger the base, the bigger the building, okay? We emerged through that, and it was flat, and you could define it with a crayon. It didn't show up on a price chart, but it did on momentum. So when we went through there, we said, this is it. Buy it here, and don't look back. And that buy zone was 1140, 1160. Since then, the lowest we've seen gold is in the 1190s. I don't think you're going to revisit that. I think that was the congestion. That was the correction. On the last day of May, we traded down to 1199. That was my projected low, was that pullback that would take out the March low and the April low, which were both above 1200, and do it just by enough to take them out and stop. That's what happened. They blew the price charts through the bottom of those 2 months lows and immediately turned, and next thing you know, you're 1360.
All right, so there's probably not a good chance of picking up a lot cheaper gold.
Oh, if you drop below 1,300 now, there's a remote chance in the next week or so you might dip into the high 1,200s. I count that as a coin toss at best. But if you see it, I'd buy it. Most of my weekly work, the shorter-term stuff, says any downside now will be a quick stab and you'll go back up again. It just looks wrong for the downside case. Even a trading case. In other words, you want to be short for 3 weeks. I just don't see it.
All right.
So I think gold's poised to go to very high 1400s, low 1500s this year.
This year. All right.
And maybe way before the end of the year.
All right, very good. Well, let me ask you about gold and the shares, gold shares relative to the S&P. On June 25th, you sent some important information out to your subscribers regarding gold and silver mining sector versus the S&P 500. And you also had a large number of individual stock charts, too, showing the relative performance of individual gold mining companies to the S&P 500. Yeah. But with respect to the relative performance of the sector, could you talk to us just briefly about how are gold shares performing versus the S&P?
Outstandingly. In fact, we thought in late 2015 that, one, gold would turn this year. Two, you don't want to buy gold, you want to buy gold miners for a change, which is a big change, as you've noted before. It's a big change up to favor the miners instead of the bullion. I think that will persist. And gold miners are up, most of them are doubled since their lows, if not better, since the lows, which occurred late last year. And whereas gold's about 30% off its low. And I think that ratio will continue. The GDX, which is the one I focus on the most, which is the unlevered gold mining ETF, not the juniors, it's up, well over 100% from its lows. It continues to congest and then inch higher, even without gold making new highs, I've noted in the last few months. It's trading, 26, 27 area. I think you're going to 39. And I think you could see it this year. As far as the congestion issue, we need to correct and all that stuff. When I look at gold, I say, no, you just went through a 3.5-month congestion correction with two $100 drops within that context of that congestion. So in other words, that was a cleansing period, a rest period. I don't see the need for another one.
Oh, interesting. All right. Well, we want to ask you about Brexit. You put out a very interesting piece on the 24th of June. Of course, that was, I guess, last Friday, and the markets were digesting the news, the Brexit news. Your title was Brexit, Momentum Looks Through the Headlines and the Tape. Regarding the S&P, what is your momentum work telling you post-Brexit? I
think the Brexit was, first off, we anticipated it, and that was based upon a spread relationship between the FTSE 100 and the Eurostoxx 50. In other words, you measure the blue chips in London and the blue chips in Europe. And the trend had shifted on the relative performance basis, where it favored, after many years of downside, where England was underperforming Europe. This changed several months ago, before the Brexit vote. Why would that relative performance trend, which had been underway for a long time, change prior to a vote that was supposed to indicate no change? So the spread was saying change is coming, and sure enough, the change came. I think the Brexit is just one of many fractal events out there that are all correlated in that they are destabilizing to the forces that want to have unified and large superstates. And that you're going to get more of the Brexit-type events. Some of them might even come from the left, like in Spain, the Podemos party, which is rising in power, which to some extent is a threat in its own way to the Merkel view of the world. And I think you're going to get more of these, and I described them in that report as not causative factors. Brexit didn't cause the market to go down. Brexit was a pinprick of a balloon, of a bubble that was ripe for busting. And the bubble can be defined different ways: high equity prices that are unjustified, especially in developed markets, and the interest rate situation. So Brexit's merely a pinprick. It's not the causative factor. It's the thing that just busted the causative factor is the existence of the bubble.
Sure. Yeah. All right. Speaking of bubbles, with about a minute left here, Michael, the T-bond, I see, with the Brexit, the T-bond, the U.S. T-bond exploded to the upside. You've been calling for some sort of a blow-off in the T-bond. Is this it? Do you think this is part of the beginning of it?
Normally, a blow-off won't last just a month. It'll last a couple. So I think if you close this month out above 170, and we're well out above there right now in the nearby futures, 173, I think, you're likely to go up, and I wouldn't be shocked to see it up in the mid-180s. But the blow-off should be brief, meaning only a month or two. And the real issue is not participating in the blow-off. It's when that blow-off fails, blow-off always implode.
Yeah.
And there's enough stuff in the T-bond market that I can see technically, especially from a momentum perspective, that says if this blow-off exists and then fails in utter exhaustion up there and turns down, which it will, there's a lot of stuff to break below, a lot of bridges to blow up, and you will have a major rise in interest rates once the blow-off ends. In other words, once yields get maxed out on the downside, when they flip, it will be far more dramatic the other way.
Oh, my goodness.
Well, safe long-term debt is very much in jeopardy later this year.
Well, I think that's very interesting in the context of what Alan Greenspan was suggesting on Bloomberg the other day, that we could be heading for inflation, some very significant inflation issues that he sees. But, Michael, we always value your work. You do such objective work. You let the markets tell you what's going on. You're not telling the markets what's happening. And so your work and you use momentum as opposed to price, which seems to me your proprietary momentum work is very, very valuable. So I want to thank you so much for being with us. Again,
if
folks,
anyone wants samples, I'm happy to give them. It's olivermsa.com. Request some samples, and we'll send out sample reports to you.